Hi, this is Todd, and we're going to do our weekly case study. This case study is going to be called Should Laura Buy Now? As we mentioned in our outline, this is a loan officer working with a first-time home buyer who is trying to decide whether or not she should continue to rent or buy. She's found a property that she likes, but she's nervous. The realtor referred to this loan officer to provide some clarity and help her to understand her options. So we're going to start off real quick here just looking at how we'd set this up. It's a rent versus own, so we would use that as our plan description. I've taken out the personal information, but it's in Wilmington, North Carolina. The contract price is $257,000. The client is a pharmaceutical rep, makes about $105,000 a year, is in a 35% state and federal tax bracket. Currently she rents at $900 a month, and she has a roommate, and she has an auto loan, a BMW, financed at 6.5%, and she's paying about $617 a month on that. We'll go over to the suitability page and just look at some of the key criteria. She has about $33,000 right now that she's saved up and earmarked towards the purchase price of the home. She was trying to get close to 10%, and she's exceeded that. So at 10% down payment, which was sort of her target, she needed about $25,700. She thinks she'll be in the house for 8 to 10 years. Her other assets are primarily in a 401k, but she has 26 to 125. When asked about whether or not she had some additional needs or any major purchases, she said yes. She has very little furniture and estimates to furnish the entire house. She probably would need around $25,000 to get started. So that money's going to have to come from somewhere, either future savings or otherwise. She also has a roommate now who's willing to move with her and would pay $350 a month to rent one of her bedrooms. So she wants to incorporate that in to her cost structure. So I'm going to go right to the Analyze page, and we're going to take a look at some of the different options. And what we want to do is help her to understand her current situation. Currently, she's paying $900 a month, and she has a car payment of $617. That'll go away in about 43 payments. We're currently saying that we would have no need to pay that off right now, because we don't have the additional cash that would be needed to pay off the car. So we're going to look at a 30-year fixed conventional. This loan officer works at a bank, has the opportunity to do an 80-10-10. For those of you who aren't familiar with that, that would be an 80% first mortgage and then a 10% second mortgage. That allows her to avoid mortgage insurance, and the first mortgage would be at 4.25%, the second mortgage would be at 5.25%, and you can see the auto is still here. So what this tells us is if we went with the 30-year fixed for this particular client on a $257 purchase, she'd have a 16-25 front and back ratio, 80 and 90% CLTV. And I can look right off the bat and see that her cost of borrowing is dropping because these mortgage costs are much lower. But I can see right off the bat her payment is going from $1,517 to $2,169, which is one of her current concerns. Now, an alternative for this particular client, based on the conversation with the loan officer, was to do a 30-year fixed FHA. So on a 30-year fixed FHA, obviously the purchase price is the same. It's a 30-year fixed. The LTV would only require a 3.5% down payment, so it would be $96.5. That would provide a loan amount of $248, and interest rate today would be about the same at 4.25. So in both of these, we want to set up her payment variables. So what would be the payment variables? Well, the homeowner property taxes are 1.65%, so that's going to be $353 a month. We would expect that to be tax deductible. Homeowner's insurance about 0.35, around $75 a month. There's no MI or other mortgage payments, association dues, etc. On the FHA, we can go through and we can do a one-click and copy all this down from the prior scenario, but we need to add in the 0.95% for her MIP. That would be tax deductible, and the MI would stop out after 60 payments. So this allows us to go through and actually model her current payment structure. Now, we're gonna start here by just comparing these two options and look at the difference again based on our three criteria. So when we're talking to Laura, we want to first look at the option, the basic qualifying or eligibility guidelines. Does she seem to be eligible for this particular property? I know in this case she has a good credit score. It's not great, but it would certainly be adequate for either a conventional or an FHA. So her ratios look good. She's got the income. She's got the down payment. Let's look at her cash impact at closing. We've got a 30-year fixed conventional and a 30-year fixed FHA. Now the purchase price is the same. Now I have financed closing fees, and we just rolled this out yesterday, but this now allows me to put the financed portion of the closing fees up here. So I'm going to finance $2,570 into the loan amount, and I have no financed fees on the conventional. This is my loan amount for both of these scenarios, and this is my down payment. I can see here about $25,700, here about $11,565. Got some other miscellaneous closing costs, cash needed at closing. I can see the difference there. And cash available. Remember, the first column is always her current situation. If she doesn't buy this house, she can continue to rent, and she'll continue to have that $33,000 that she saved up. If she buys the house, then she's going to have about $5,300 left over in this scenario, because she's going to need to bring about $27,700 to closing, which after eating through her $33,000 will leave her about $5,300. With the government FHA, you'll notice she's only going to need about $13,565 cash at closing, and taking that out of the $33,000 will leave her about $19,435. So I already can see that from just a conversational standpoint with Laura, we can say it looks like you can qualify, and based on your goal of being able to furnish the property, the FHA 30-year fixed is actually going to provide you close to $20,000 left over at closing to furnish that property, versus this is going to leave you with about $5,000, meaning you could do a little bit now, you'd have to do the balance over time. Remember, we're looking to answer the three key questions. The first question is, what does this do to my cash at closing? What does this do to me financially at the closing table? And I can say you'll have $33,000 if you continue to rent, $5,300 if we do the 30-year fixed, about $20,000 if we do the FHA. The second question, what would this do to my cash flow? What would be the impact there? So we look at these side by side and we see there's no impact if you keep renting, because that's our baseline. You're currently spending $127 a month in interest, $900 for rent, $490 in principal, around $1,517. So if I look at that, I'm going to shrink up the after tax for a second, and I compare that to the new scenario. I'm at $2,169 and $2,461. So my payment's going up by $652 a month or $944 a month in these two examples. That's a dramatic shift, and this was a concern for her that she couldn't afford this larger payment. She obviously has the cash flow for it. She can make that differential, but when we expand the adjust for taxes and rental income, two things happen. One, she has a roommate that's willing to spend $350 a month, so we get to include that in her cash flow for helping her think about the actual net payment. And then we have the tax savings, in this case $418 and $499, because there was no tax benefit to this rental payment. In her 35% tax bracket, we now can estimate a $418 or $499 a month tax benefit for her if she itemizes those deductions. So now we have an after-tax payment of $1,517, $1,401, and $1,612. The monthly payment difference is positive $116 on the conventional, meaning her actual net at the end of the year after tax payment is going to be less than her cost of renting, and her FHA loan will be more by about $95 a month. So you can see the value of looking at the pre-tax and the after-tax component when trying to give her an estimate of what her expenses would look like, because with just the pre-tax, it looks like her payment would go up by close to $1,000 a month. But she wanted to incorporate, again, $350 a month for rent and the tax benefit. So this could answer those first two key questions. What's the impact of my cash at closing? Okay, I still like the FHA here because it's giving her a lot of leftover reserves since she doesn't have a lot of savings. And the cash flow impact here is getting her close to about $95 a month. That's not a big expense. Now she's going to really pay this difference here. Her actual payment is going to be $2,461. In this case, she'll be paying an extra $944, but she'll have $350 coming from her roommate, and she'll have about $500 coming in tax savings over the course of that first year. Now, obviously, that'll go down over time, but this is just a snapshot at closing to look at the impact. If we're going to look at the impact out further, and this is one of her big concerns in this situation was, should I wait and buy later? Is now a good time to buy? Is this financially a good idea for me? So her target time frame was 10 years. So we have the slider here set to 10 years. And An important thing to consider, especially if you're really kind of new to the software, slide this over to 0. Because what this does is this zeroes out everything at closing. Meaning, at closing, if she doesn't buy this property, she has no house, no mortgage, she still has her car loan, she still has her cash. If she looks at her balance sheet, she has $95.70 in equity. She owes she owes $23,430, has $33 in cash. That's a positive $95.70. If she buys the house at closing, she has a house worth $257 at closing. Mortgage liabilities of $231.3. She still has her car liabilities. She has about $5,300 in cash left over at closing out of this $33,000. Her actual net difference at closing is only $2,000. Why only $2,000? Because when I look up here, the only thing that she's paying out of pocket is that $2,000 in closing costs. Because the other stuff, the down payment, is going into reducing her mortgage liability. So it shows up on her balance sheet as negative $2,000. On the FHA, it's negative $45.70 because she's having to pay $2,000 in closing costs and then she's financing in $25.70. So it's a nice way to start, just to simply kind of get started with at closing. This is the impact to your wealth here. And then what we're going to do is look at what does this look like over, say, your target time frame of 10 years. Over 10 years, and again, we're just using a cash-on-cash basis here. You still have $33,000. We're assuming no interest or compounding, just looking at the money. You have a house worth $257 still, but your mortgage balance is now at $189, and you had the $5,300 that was left over at closing. So I can see that one of the big differences here between renting and owning is I have $40,000 in equity and $46,000 in actual equity. Now note my property appreciation rate is at 0%, and I'm going to leave that there for a second, and I'll tell you why. Now over 10 years, if I keep my rental property and I keep renting and I pay off my debt and I have some negative interest here from that my auto loan, I'll spend $144,560 over 10 years, keeping my current situation just like it is today. If I buy with the conventional, I'll spend $165,291. If I buy with the FHA, I'll spend $183,487. That difference is negative 20 or negative 38,000, meaning my payments are going to be higher over that 10-year time period. But what do I have to offset that? I have some equity that's actually going into that property, and I'm assuming no growth. So my net difference, my savings, is positive 19,534 on the conventional and positive 74,85. So if I'm sitting here with Laura, what I can do is say, you know, I like both of these scenarios for you because what we've done is assume your property doesn't depreciate and it simply maintains its current value for 10 years. You're still $19,534 better off buying than renting over that time period. Plus you have use and control over the house and the property, and you're about $8,000, $7,500 better on the FHA. Now, what that allows you to do is say, now, if the property does appreciate, and let's just say that it appreciates at 2%, close to the inflation, then I can see that that dramatically impacts the house value, which has no impact on your rent because you have no house value here renting. That's going to increase your flow through, and now you've got about 76 versus 64 financial impact over that time period. So what I could say with some degree of candor is that if the property just holds its value for 10 years, consistently stays the same, you're still better off here owning versus renting. Now, if it depreciated, that would probably have a negative impact. It would have to depreciate a couple percentage points to actually wipe out your savings. If you feel more realistically the house could appreciate at just say 1.5%, again, you have a much better situation here, owning versus renting. Now, one of the questions for this particular client was, well, what if I wait a year and I can buy the house cheaper? So let me show you a way that we could show this, and the way we illustrated this for this loan officer is we did a 30-year fixed FHA, all right, and we assumed that the property goes down 3% over the next year. So in a year, she can buy the house for 3% less at $249,290, but that interest rates go up 1% over the next year. So she has a risk here. She could wait and risk that property values go down, but also she could have some risk that the interest rates go up. And you could model this any way you want to. You could call this particular scenario wait 1 year, and have it be, and then just put in whatever your scenario is. A property value that's going down, interest rates going up. Property value going up, interest rates going up, interest rates going down. In this case, what we did is we said, look, let's just see that you could get it 3% cheaper in a year, but interest rates at an all-time low are more likely to go up. What would that do for you? All things being the same, you see the cash at closing is the same, but the interest rate is going to drive that payment up from $95 after tax to $142, but she is buying it at a cheaper price because her house value is going to be less, and her mortgage balance, see, her mortgage balance is going to be not $248 but $240 based on this. But what's really neat about this is in just one or two clicks, I can go right down to the bottom line here and say, if I look at this, let's just go back to assuming no appreciation over time. If you waited 1 year and could buy the house for 3% less, but interest rates went up 1%, over 10 years, this is going to be a better solution for you with the conventional or the current FHA. Your actual cost is going to be negative $5,880 by waiting that year in that scenario. And if we look at, again, taking the appreciation to 1.5%, okay, 61.49 or 34. So in your case, it's not making a lot of sense if you believe that you can get the house a little bit cheaper, but we're actually looking at some of the current interest rate risk. It may not be worth waiting over that time period. And again, you can model this any way you want to based on what you think is realistic. If you think she could get the house cheaper in 1 year and get the same interest rate, then absolutely, we should be able to come down here and very quickly see that that would have a positive difference for her, $49,662. But it doesn't have as big of a difference, that lower payment, as that interest rate does. That interest rate has a much bigger impact on that cost of borrowing over time. So hopefully this will be helpful. Is this a good time for Laura to buy this house? And the question would be, there are certain risks involved, but if she's found a house she likes, she has the money saved today, and she feels like just confidently that at a minimum the house will hold its value, she'll be better off financially buying that house today than she would be continuing to rent. The only downside for her would be if the property values dramatically drop from here. But given their current position, if she's buying in the right market, in the right place, and she's willing to be there for a longer period of time, in this case 10 years, it's probably a pretty good decision. If she said, I'm just going to be in the house for 2 years, and she's going to buy it speculatively, 3 years, I'd say it's not worth the risk. It's really not worth the risk if you're buying it just for an investment. If you're buying as a place to live, you think you'll be there for 10 years, you think you could have at least a 1.5% growth rate, now it's really making sense. But you can do that very simply, and for this particular client, communicate her concerns and her issues in a way that help her to make a decision to move forward. In this case, this client will be moving forward and purchasing her home. So hopefully this helps. Good way to say how would you talk about whether or not now is a good time for Laura to buy a home from a financial standpoint. We can go through into a variety of scenarios here and get right down to that bottom line. If you want to do some more advanced stuff, you could even look at prepaying or savings and looking at how quickly could she be debt-free. For example, if she continued to take that car that she's got and she takes that monthly payment and applies it towards the house and prepays that savings difference, she could actually pay that house off in something closer to 20 years. Hope this helps. Have a great day. And please keep sending in your case studies and examples, your questions, and let us know if you've got something that worked really well for you. We'd love to feature it on either a case study or a learning session.